Hmm. Okay, so how do I get, because this link isn't working. Let me click view and watch page. That takes me to the Bitcoin and beers. Okay, so all right. Let's get this into the Discord and we'll get going on the TA lesson. Let some people get in here. Hello, guys. Hello to you. How's everybody doing today? Make sure you guys can hear me okay. Crypto Wolf, what's up, bud? Give it a couple minutes to let everybody get in here. I think the sound's okay. Make sure that you guys make sure that you change the stream quality, the settings, the video settings to 1080p for the best quality. Just to make sure you guys can see everything, okay?
Believe that you can. Cool. So
There's 5 people in here now. It doesn't matter because this is a lesson that you guys can watch after work or whenever. Really, it'll be available to you as long as you're in the private group. Um, this is one that a lot of people have requested in the past, and it's how to find the right stop loss or the stop limit area. Um, and this is a big issue for a lot of new traders is knowing the right area to put a stop, to be stopped out. Like how do I know that that's the right area? And I will preface this by saying a lot of it is your own discretion, right? But you can have criteria to um, to help guide you, right? So the first thing is that the first rule, okay, and you can write this down if you want, is that I only use candle closes to determine my stop. Okay, I very very rarely have a a hard stop, and if it gets that price, it's stopped out no matter what. Like period. Like guys, it almost never happens. And the reason for that is because there's a lot of fake outs in this market, and I'll show you some fake outs. There's a lot of fake outs in this market. And so my rule personally is depending on the trade, depending on my risk tolerance, I will be stopped out one of two ways. And they're both on candle closes. The first is 2 4-hour candle closes. And the second, and because the first 4 hours confirmed by the second, if they close below my level, okay? And the second is 1 daily close below my level. You can still get faked out by 1 daily close and then closing back above and you got stopped out, but it's way less often, and you got to stop out sometime. So I'm going to get to some charts. I'm going to show you some fake outs, and I want you guys to see why we use candle closes, because they matter. All right, so let's go to Ethereum on the day chart. I'm going to delete this here, and I want you guys to see that if we were going to close just right here, if we had entered an order near the bottom of this range, obviously that's where you would try to get in. I would say, hey, you should probably, if your risk tolerance is fine, you should probably put your stop order under the lowest wick of this range. But if you do that, and this is just this past few weeks price action, if you do that, you see how you could have been faked out. Okay? Because if you would have stopped directly under the low of this candle, and this candle, the low is 404.22, this candle broke down. It got down to $395. And the daily candle, although it hasn't closed yet because we still have 11 hours, 10 hours before it closes, it looks like it could be bullish hammer reversing right back above that stop line. So what do we call that? We call that a stop hunt, okay? Because whales, market makers, whoever, you name it, more whales than market makers, they know that your stops are below this line. It's evident. They know that stops are below this line. They know it. So if they push it down that far, they can get your stops before it goes back up. Because you got to remember, everybody's in this market to take money from each other. That's the rule. So it's very important to do it on a candle close. And if we're looking at like, I typically do a daily candle close personally, okay? But if we were to do 4 hour, because if we were to do 4 hour candle closes, would you have been stopped out below this line? No. You would have been protected on 2 4 hour. This is why I say this is a perfect example. 2 4 hour candle closes. This is why you do it, because you get one and it closed below this line, and here's the second one that powered right back above it, and you didn't get a confirmed close. So you would have been fine on either. If you want a faster signal, it's a little bit less reliable, okay? Because a daily candle has 6 4-hour candles, and we're talking about 2 4-hour candles, right? So you have to talk to yourself and figure out what your risk tolerance is, what risk you are willing to handle, and then go with that. So we're going to, I think the best way to do this is to line up some prospective trades and talk about where your stop could be, okay? So if we're going to take this green line off. I'm going to make this full screen so you can see a little bit better. And if we were to take a trade on this pattern, and you wanted to buy the third touch of this trend line here, and it broke down immediately down below, and you don't know what to do, you would have two levels of stops. This is just finding stops. You would have two levels of stops, in my opinion. The bottom of this candle wick, the bottom of this candle wick. Okay? So we're talking about buying a diagonal trend line. And for me, my stops on a diagonal trend line are always off a horizontal. Okay? So I'm buying the diagonal trend line, but I'm looking for my stops off of a horizontal level. So there's two levels finding that you could find the right stop here with. The bottom of this candle or the bottom of this candle. And we always talk about wicks, guys. We don't talk about real bodies on stop levels. Unless it's a massive wick, then you probably would need to look at it further and decide if that's real body or if there's a wick next to it that is really within market structure or something, but we're not there right now. So your two levels here, let me make these lines a little longer or a little wider. These would be your stop levels, okay? So a loss, if you would have bought on this trend line, if you would have been stopped out, it would have been right there, 5.7%. Because where did the second candle close at? That's where you would be stopped at. So from where you bought down to where the second 4-hour candle stopped at is where you would, if you did two 4-hour candles, would be your loss. You're still in the trade if there's if you're doing the daily candle. So you have to decide. And if the thing here is that if you have a big risk tolerance, you could choose, instead of stopping out on this trade, if you bought this range here, this green trend line right there, you could choose to average down in this spot, or on this long-term trend line. Okay. Let's make this a daily. Let's go back to the daily so this is easier to see. There's your long-term trend line. 1 touch, 2 touch, 3 touch, candle back above. Okay. And you could choose, because you would be stopped out on the daily below this level if you have a super low risk tolerance. And the downside of having a super low risk tolerance and choosing a higher up level of where you'd be stopped out at is that you can get what we call chopped up more in the market. Okay, so normal price action stops you out more often. Okay, where that if you didn't have quite that low of a risk tolerance, that you would have been fine anyway and probably ended up profiting or getting out break even, something like that. So that is a drawback. And just like anything else in life, guys, you know that there are drawbacks to everything. There's give and takes, opportunity cost. So instead of, you could be stopped out at this level. You could be stopped out on daily close below this. Or you could try to average down on this trend line. Okay? Average your average entry down and try to get it on a bounce. Well, where would your stop be if you tried to do that? It could be a few areas. I'm going to get rid of this trend line here. To me, it seems like it could be below this range. on the top of this wick here. Doesn't seem like much, but it's another level. Or the last one I can see here is this level. But then, guys, you're looking at $290. I mean, you're looking at buying at $440 and selling at $280, $290 if things go against you. So again, it depends on your risk tolerance, but you need to know this before you take the trade. We're talking about a swing trade here, not a quick flip. You need to know this before you take the trade. And you need to decide what your trading plan is going to be. Am I going to buy this trend line? Okay. Well, if so, where will I be stopped out at? Where am I willing to average down at? And where am I willing to stop out at? For me on this trade, I would be willing to average down on this trend line. And I would take an entry of less than 50% of my intended position, probably 30 to 33%, maybe 25% of my intended position size. Here, average down way more of it here. And so my average price from 440 down to 390, that's a difference of $50, and 25% of that is 1250. So we're looking at an average position entry of 402.50. Okay? And I would be willing to stop out below this second line here, like 350. And we're looking at like a 15% loss there. But when you take trades, it should be no more than 5 to 10 and 10 if you're being really aggressive of your overall trading stack. And 15% of 5% is 0.75%, 0.75%. This would have represented a 0.75% loss of my overall trading stack. Okay? And because I typically take like 5%, like 10% is not often. But and so my risk management saved me not only on my position sizing, but my ability to average down into a position. We're trading the day chart here, so it's probably going to be a swing trade. And we're buying key levels, and we have our stop criteria. Well, we have everything that we need to take this trade. And it's because we defined our stop criteria beforehand. And so remember, I mean, stops for me, guys, are typically on horizontals. Okay, even if you don't use Fibonacci on this, because we're looking at a spot here where there aren't really any Fibonacci levels of this move left to buy. I mean, you could look at the 0.93 where it kind of bounced if you wanted to, and you might want to do that because it's within this trend line. But at the end of the day, like, these levels are right below it, and you have to decide if getting stopped out at these levels is okay with you, or if a daily close below a long-term trend line is okay with you. So it's a lot of decisions, it's a lot of talking with yourself, but you can take some time before you take the trade, because we never rush into the trade. We trade higher charts. We never feel the need to rush into the trade. You can take a little bit more time and figure out your stop criteria. So draw your horizontal lines, make them all the same color, maybe, I don't know, and figure out if you want to average, yes or no, I want to average down at this level or not. I'm gonna put capital into averaging down in this level. And if you decide that you want to average down, you should never, in my opinion, make the second level that you average down with less percentage-wise than the first level that you bought in with. Okay? Personally, how I feel. I feel like if you can pull your average entry to 50% in between the two entries, or below 50% between the two entries, that gives you a better chance of at least getting out on a bounce. Okay. And if your stop criteria on a daily candle close, like you're giving the market every single opportunity to at least get you out on a bounce or to get you into profit. And if a daily candle close below your key level happens, sometimes it's just not meant to be. But you protect yourself by averaging down, sometimes if you decide you want to, by using higher time frame candle closes below key levels that you've already decided that those are your key levels, those are your stop levels, right? And then your position size relative to your overall trading stack, all of those together will help you when you get stopped out. Okay? Let me see if we have any questions. 7 people. Anybody got any questions? Let me know. If not, I'm going to continue going. Let's look at Cardano. Okay. So if I were to buy the 20 EMA, because we always talk about buying the 20 EMA, you have your overall market structure here, right? It fell through the 786. You're hoping that it bounces on this line just like it did before. If I were to buy the daily 20 EMA bounce after this, I'm going to buy at 2270. We'll call it 2265. Okay? We'll call it 2265, right above the daily 20 EMA for a bounce. Where would your stop criteria be on this one? Okay? Because I love buying daily pullbacks to the 20 EMA. Not in this situation always, but if you were to buy this, we're taking prospective trades here. Because if you're going to take trades moving forward, you're not going to have taken them before and you won't have the benefit of hindsight. So let's do this actively. I would say you would want to do this, the wick of this red candle right here on a daily close. Why? Because if you take this big long candle, it's about 50% of it. Okay, so there's a 50% retrace off that huge move. And we'll draw a horizontal here. You were still protected, you still would have gotten out a profit, and you would have been good to go. If you decided that you wanted to try to buy this trend line for, from here to there, and you want to bet that the third touch of this trend line will save you. Well, first off, a trend line needs 3 touches to be accurate and only has 2, so you would have to hope there. But you would have bought at 2265 and 2000 sats. Okay, your average minimum would have been 2130-ish, right around there. Your maximum average price. Okay, because the max you would want to go up here is 50% entry. 50%, it could be 25, 30, something like that. If you decided that this wasn't your hard stop and that you wanted to average down, okay, and hold for a bigger gain, then where would your stop levels be on this one? Well, this is the first area. This is the second area. And so if your average price is 2135, 2130, and you get stopped out below this orange line, that's a 7% loss. 7% of 5% of your overall stack is 0.35 of your overall stack. That's not a lot. Down here is 10%. So you would have lost 0.5% of your overall stack trying to take this because you average down And this is if you decided to average down. If you didn't decide to average down, you just got on a profit at the 50-day moving average or something like that, you would have been fine. Or if you held, you would have been stopped out right here on this daily close. Okay? So we're pretty much looking for the lowest wick in trading ranges. That's pretty much it. I mean, and then but define it beforehand. Have your trading plan. Define it beforehand, like I said before. Find where you want to average in or average down, how much of your overall position you want, where you're going to average down at, if you're going to. Define your stop levels before, and pick one of these levels with your trading plan and say, you know what, that's where I'm going to stop out at. Okay? But the biggest thing here is being patient for entry. So I hope that makes sense. If you would have stopped out below this horizontal level here, you would have lost 10%. It would have been 1879. And the second that daily candle closes, you're out. Because it triggered your criteria. You got to be disciplined with it. Check comments again. 4 hours usually enough to manually stop after close or should be higher. I go, like I said beginning of this video, I go 2 4-hour candle closes, 2, not 1. Trust me. 2 4-hour candle closes or a daily close. Now, a daily close is 3 times longer than 2 4-hour candle closes, so you have to decide which one is right for you. Again, it's decisions. But when you make these decisions and you write them down of what your criteria is on this trade, those are your decisions, and you have a trade at that point. You're not just hoping, you have a trade. So, and these are for swing trades because that's yeah. So how to find the best buy zone? I should do an entire video on that. To be honest with you, you buy pullbacks though. That's for sure. You don't buy into green. You buy pullbacks. So let's pick a random chart and find a random trade. I know BNB just reversed. Could it have stopped us out anywhere? It could have. So you could have bought this daily 200 moving average, like right on top of it, the touch of that, and been stopped out on a daily close below. That happens. And you're going to get stopped out. You're going to get stopped on it sometimes, guys. There's not a lot that you can do about it. You're going to get stopped. If you're working with your stops, you're going to get stopped on it sometimes. This is a perfect representation of that. Okay? So, let's look for another one. Look at EOS. So you could have bought this trend line up here. And let me make this easier. Let me make this more viewable. I think it's important personally to, if you want to give yourself every chance in a trade, to have your macro fibs on there to understand where price is relative. To your stop levels. So you could have bought this trend line, right? You wouldn't have bought this. You would have bought the 618, but or the 0.5 right there. But you could have bought this trend line, and you did get a day. If you would have bought it like right here or right there, you got a candle close up above that. But then if you're getting stopped out, you would have gotten stopped out 154K sats. I'm not sure that's a trade that we would have took like that. But you could have gotten out the day after, 2 days after. That's the problem because you have this macro fib underneath there. I don't know if that's a good example. Let's look at Litecoin, see if we can find some. Okay, this is another perfect one. So with Litecoin, and this is Bitstamp, I'm going to delete everything and start fresh on this. We're going to go 3 days so it's easier to see. Okay. All right. So before you do anything on charts, it's always wise to draw support and resistances. Right there's one. And this is much like that ETH trade, but we'll do it again. Okay. So there's that. And there's that. So you could have bought the third touch of this trend line right here. $76, right? And then where would your stops be? Where would you average down at? Could average down, here we go, 74. So you would have bought at 76.50. The low of this candle is 74.11, 72.52, and 70.40. Okay, and you would have to decide that if you're buying at 76.50, are you okay with a 1% loss? Are you okay with a 3% loss? Are you okay with a 5% loss? Or are you okay with an 8% loss? Assuming you don't average down. Okay? And then you'd have to decide if you do want to average down. Let's say that you average down at this key level down here, 70.40. 76.50 minus 70.40 is $6.10. Divided by 2 levels. The max difference between that is $3.55. Okay? So 76.50 minus $3.55 is 72.95. So tab 72.95 right here-ish is your average entry. And if you get stopped out below that, below here, let's say it's like somewhere around here, the daily close, you're looking at like a 5% capital loss. Okay? So that's a way to kind of manage to protect yourself using stops, like by averaging down. But you'd have to decide what your loss is, and then these would be your stop levels. Let's try to find more stop levels on regular trades. Mcash is probably a good one. Might have fallen. If you were to buy this trend line here, forget the fibs, right? Because this is a new market and you wouldn't have had this fib drawn when you would have taken this trade, because you would have known this is the top. And let's say you want to buy, here's what I see being bought, is this. Back then, this is where you would have tried to buy. Right there. There's your trend line, right? And you're probably looking at this at the time as an ascending triangle right off the rip with false breaks above, and it's only a matter of time. And you want to buy right back at this trend line if you can. So you would have bought a 435 sats. Okay? You would have gotten a candle close up here, 485. All right, everything's good to go. And then it comes back down. Well, where would I put my stop on this? If I buy 435 sats, and this candle hasn't been printed yet, so I can't use the low of this candle right here as my stop because it hasn't, when I decided I wanted to take the trade, it hasn't happened yet. So where do I want to take this stop at? There's a couple levels that I could think of below this candle range. Here. Let's move down to the 1 day though. This is such a new chart. Let's see. You could do that. You could do here. Or on a daily close below the trend line. Well, let's line it up. Let's assume we don't average down, okay? Let's assume that our plan is not to average down, and you buy at, we're going to call it 440 sats. I'm sorry. So 440 sats. Where's my pen? My wife keeps taking my pen. Never mind. 440 sats is right here. And below this range, this is a little bit horizontal. Two candles right here, right? And we're buying horizontal levels. So that looks about good. And that's right at that psychological number of 400. It's probably where you put your first set. Well, if you buy, that's 10% loss. Isn't it? 440 down to 400? How is that not a 10% loss? Okay, 9% loss, I guess. It's baffling me, but whatever. That's a pretty significant loss. Would you take a 17% loss? I doubt it, man. To be honest with you. Off a trend line, off a new market that's been not established before, I probably wouldn't. Would you take a 29% loss? That'd be tough. So I think off a new market like this, you'd probably go with like a 10% loss max. And then that'd be 0.5 of your overall capital. But when things bounce, if you would have bought a 440 and it closed at 480 and you got your 10%, I would have taken some profit up top to protect my entry down here. And if I would have taken 20% profit, that would have averaged down my entry to somewhere around like 430-ish, 435-ish, 433-ish, something like that. And then, say 433-ish, my loss would have only been like 7%. So, I don't know. Is this making sense to you guys? Let me know what you think, or if you have questions. But because of this, guys, I don't really put in stop limit orders on exchanges. I put alerts on my trading view to let me know of certain prices. And then around daily close time, I'll come around and I'll look. The daily close is 8 p.m. Eastern Standard Time. And I'll look, and if I get stopped out, I got to manually stop myself out. It is what it is. So let me know if this is making sense to you guys. It pretty much comes down to your risk tolerance, what you're willing to risk, whether or not you want to average down for a bounce, and to lower your overall loss if you do get stopped out. I mean, maybe we should look at like bullish times when you could have gotten stopped out, but you didn't. Let's look at NEO last market cycle. So you buy the daily 20 EMA. Where would my stop be? Probably on a daily close below this line. Former resistance turn support. You buy the daily 20 EMA. Where would my stop be? I hate when it does this. Probably resistance turn support. You would have gotten so many gains from that. Bull trends, it's easy. You don't get stopped out that much. You might say, let's look at this trend line after the bull. You would have bought this trend line, you would have been stopped out. Right there. What's that represent? 10%. It's kind of how it goes. Sometimes that happens. Why it's risky, a lot of failure swings. Yeah, you can get, if you use just a 1 4-hour candle, the market's got a bigger picture than just 4-hour chart, man. The 4-hour chart's not a high time frame. It's just not. So yeah, you can get a lot of stop hunts off of the 4-hour chart. That's why, if I'm quick with it, I'll do the 2 4-hour candle closes. But a daily candle is still 6 4-hour candles. Okay, so it's 3 times as many candles as your 2 4-hour candle swings. So you got to use discretion. You got to decide what it is that you're looking for from the trade and what you're willing to take. But you need to have that all decided beforehand in order for you to make the right decision. And the right decision isn't always the right decision. Sometimes you get stopped on it, and it happens. But a plan like this should protect you most of the time. If you're buying key levels on high time frame market structure, you should be protected from most of the time. So, any additional questions? I hope that makes sense to you guys. I mean, it really comes down to, you find the level you want to buy. Stop levels are usually horizontal. And you have to decide if you want to average down or not. And then I typically, most of the time, like 95% of the time, use daily closes below those key levels that I'm stopped out at. And it is what it is. Sometimes you get stopped. Yeah, Adrian says, I think 2 4-hour candles is a good idea. At minimum, I cannot stress this enough. At minimum, 2 4-hour candles. 4-hour is not a high time frame. It's not. I'm sorry. It's not as reliable as a day chart. A day chart is 6 times as reliable as a 4 chart. The signals that as a 4-hour chart, the signals that you get. 6 times. 3-day chart's 18 times more reliable. Weekly chart is 28 times. Okay? Oh wait, no, 42 times, excuse me. A weekly chart's 42 times more reliable. Because for a weekly chart is 42 4-hour candles. So, all right, doesn't look like we have any more questions, guys. If you do have any more questions, let me know. It's really simple, but you have to have a lot of conversations with yourself to find the area that you're comfortable with. Okay, and it's important that you gotta give trades room to breathe. You got to be willing to put some skin in the game if you want trades to work out, especially in this volatile market. So, all right. If I need to make a follow-up to this or something, if I miss something, I'll be more than happy to do so. But this should cover it from now. Wait, Michael R says, here's a judgment call that I always sucked with when I traded. I buy X coin. I'm aware you can't always buy the very bottom and sell it at high top, but when it dips, when do you cut losses and begin a new trade? When do you cut losses and begin a new trade? I would separate those and make sure that you don't begin a new trade after you cut losses, like right away. And I don't know if that's what you're saying or not, but that's important. Go back, look at the trade, see what you did wrong, learn from it, and then be patient to find a new entry. But you cut losses when your stop criteria is triggered, and I just showed you guys what your stop criteria would be on a few trades. Um, you know, you cut losses because you do your due diligence before the trade, and you find what, again, if you want to average down, and then at what level what horizontal level you're going to be stopped out at. If the daily, and I would say, guys, I'm almost recommend, like, straight up, like, the daily is what you need to get. Your daily candle is what you need to get your stops off of, in my opinion. I can't recommend it any other way. Even for you guys, like 2 4-hour candles, I don't think is the right thing. So you've done your due diligence before the trade. You have your key levels. You have your horizontals. You know if you're going to average down at a certain level or not. And then you have your level where if the daily closes below it, you're out. Okay? And it's typically based off horizontals. And they should be apparent to you. They should be swing lows, like wick lows of the swing. And it's that simple. This is a 24/7 market, so you can't always catch it, but you can come back at 8 p.m. Eastern every single night and see if your stop criteria was triggered, and then go stop yourself out manually. Because again, I don't do automatic stops; I do manual stops. I can't put into the system on a stop limit order at after 8 p.m. This can trigger, so it is what it is. So I think that covers it. If you guys have questions, get me in the chat in the private group, and I can answer questions for you guys. And then if I need to make a new one, if I missed something, I'm sorry, I don't think I did. It's a pretty simple topic, but go back and watch this a few times. Make sure that you guys are privy to what I'm putting down, and let me know what you think. All right. Thank you much.